The Hedgeless Horseman here. It's September 4th, 2025. First of all, thanks to the sponsors. Consider me biased or twice biased if I talk or mention any one of these. Not investing advice. I'm gonna try to put out a few videos. Well, who knows? Maybe this will be the last before I go to Beaver Creek. But we're in interesting times. Of course, and some might have watched my last video, and I pointed out the fact, and I also pointed out on K report, which got published I think yesterday. It's like we have to have a strategy that we stick to. We can't be flip-flopping yada yada, and like I said, in the yesterday's video. One day it's easy to buy when stuff is up, everyone's feeling great, yada yada. There's memes and higher price target and gold hitting all-time highs. And I said, fast forward and it's like, don't buy anything that you're gonna feel like selling on the the very next day the sector is red. And lo and behold, it's like I said before, if my bet is that if gold is up today, it's gonna probably be down tomorrow, and if it's down tomorrow, it's gonna be up the next day. It's like a coin flip almost. But you can see how much effect it has, and of course, nobody sells juniors when gold is red because gold is red. People sell juniors or any mining stocks because they think they might be down more tomorrow. It has nothing to do really with the value of the actual projects or anything like that. It's just people that project the daily trend to tomorrow. That's basically it. People bought yesterday when everything was up because they think they might be higher today. And today the opposite is happening, right? And I think it also shows that what kind of a wall of war we're actually climbing here. I think people are still very sensitive. That's a good sign because it means that sentiment is not that high yet, not in the junior space. People are very anxious. As soon as we have a red day, regardless of how cheap they are. Some juniors are up 100, 200%, 300%. From 2024 bottoms, and still they're very, very cheap. They have no business going down if gold goes down from 3,640 to 3,600. It's a ridiculously high gold number, and the projects that's spot gold are worth a lot, but they still go down. And again, it has nothing to do with value, not with price not price relative to value. It's only daily sentiment and people guessing that better sell today because I think they're going to be down tomorrow. That's how short term a lot of the trading is. Because it's usually emotions that gets us to buy and sell. It's, I was going to say, common sense and how do I put this? It's the holding that makes you the big money, right? But we usually buy and sell based on greed or fear. And that's why it's like the more you trade, typically, the more you buy and sell, the more mistakes you make. Because most of the time, the biggest influence on daily trading, on any trading, is emotions. So if we hold for a long period, we're not using our emotions then, right? And we're being patient, which is controlling your emotions in a sense. We see it today, and also notice like today. The first when I looked at the portfolio, sometime after the market open or the portfolios, it was mostly beta down and alpha up. Developers, producers, advanced exploration plays, they were down a bit in price, and some early stage or at least exploration stories, they were up. Why? Why is that? Makes perfect sense, because and that kind of proves the point that the only way to really make money in a bear market, for example, is to have incredible value creation, and that usually comes via the drill bit. Because if gold price is going down, okay, you have a mature project, the gold price is simply going down. So on paper, at that very moment, using spot gold, the value of that gold project is going down. Whereas, like, if you have just an exploration project, you start off with 0 ounces, and you discover something, you go from 0 ounces to, let's say, 1 million ounces to start with. That's a big value change. That's a big value creation, even though gold might be down. If you double your resource or triple your resource, that outpaces the on paper value decrease of your gold project thanks to the gold price going down. So it just again shows just how, I mean, how every day is the market flip-flopping basically. So as soon as there's a declining gold price, we see, alpha plays seeing bids, because the idea is that, well, they can do well if the sentiment is bad, or if gold price goes down. And tomorrow, if gold is up, you're not going to see buying in the alpha names, you're going to see buying in the beta names. So it's like, okay, what do you do really? I mean, in actuality, you should pretty much do the opposite, right? I mean, I don't do day trading like that, and even though I do value shuffling, I mean, usually it's not on a day-to-day basis, because there's no way you can exactly know how. I don't have an exact number of value on any project, but if you think about it, what we've seen just in the last 2 days is that yesterday beta was up, alpha got sold. Okay, today alpha gets bid and beta gets sold. So people are buying alpha today, selling beta. If tomorrow comes and gold is up, and sentiment is a bit better than today, the beta is going to be up, which people just sold today, and alpha is probably not going to see bids, which people bought today. So it's like the market, in a sense, when you think about it, Mr. Market is continuously kind of destroying itself, in a sense. Because if you just had, if we had every other day, it was completely flip-flop, that sentiment and gold price goes up one day, the next day it goes down, and you just do that, even though it's not going anywhere. Let's say the gold price goes up 1%, the next day down 1%, then up 1%, down 1%, yada yada yada. If you just did what Mr. Market is doing, you would basically, erode your entire portfolio. Why? Because every day gold is up, you're going to be buying beta plays, and every time it's down, which in this theoretical scenario, it's the very next day, you're going to be selling beta and buying alpha. And then the next day comes when alpha goes up, so you're buying that and selling beta. So you would just erode away your entire portfolio if you do what Mr. Market is doing, basically, at face value. Because again, that only makes sense it makes sense because people buy what they think might be up tomorrow. That's it. And if it was a coin flip or 50%, if every day is followed by a day that's completely different, then you would just, again, be buying high, selling low each and every day for, infinite time. So you would have nothing left in the end. And this is why it's important to, again, it's like, always look, the market is reacting, the market is trading based on, almost every buy and sell is short-term focused. So we're seeing people vote with their feet on a short-term basis. Again, they're not thinking about projects, they're not thinking about value, they're not thinking about a news release that's 3 months out, or even maybe 1 month out. They're only thinking what they think the share price is going to do tomorrow. That's it. But when you look at some of these juniors, again, let's say some juniors down 5% today, which implies that all the intrinsic value and all future possibilities within that company got 5% cheaper. AK, if you believe the market was right, the entire intrinsic long-term value of the company went down 5%. Because, let's say, gold is down 0.6% on September 4th, 2025. Does that make any sense? 1/20th, 5% of the entire long-term value. All the news releases over the next 12 months, 24 months, 36 months, who knows, maybe the company will be around for 10 years. So all of that value, or 5% of that value just disappeared because gold is down 0.6% one day. Obviously that's hyper bullshit. It couldn't be more silly. So that's what we again have to, we have, because we get bombarded by everything is short term. Twitter is short term, forum is short term, people guessing what the share price is going to close at the end of the day. Most, let's say, paid services or most technical account that has a lot of followers, it's what people, guesstimating what the next imminent move is going to be. What's the short-term direction? Everything is focused on that. And that's obviously the whole reason why everybody sells low and buys high. Because the short-term trend is always up at a high, and the bear market bottom, the short-term trend is always down. Right? And I would say this, the 2024 bottom in the juniors was the most crazy thing anyone's ever seen in 40 years. So it just shows how much momentum driven the sector is today. It's absolutely crazy. It's probably more bullshit than it has ever been. So in my opinion, that makes patience and, let's say, a long-term value orientation is probably if you have patience and a long-term picture and, let's say, a sense of what value actually is, you probably never had a better edge. So it's like this, we probably never there hasn't been a better time to invest if you have, let's say, those qualities. Because we're supposed to think when the market sells something off, let's say 5 or 10%, whatever it might be, in something, and the story is obviously completely unchanged. 5 to 10% of the value didn't go up in smoke since yesterday. It might actually be, without the news release, obviously nothing has changed. And who knows, maybe that this very day, when a junior is down, maybe they have boots on the ground and they just found something. Or maybe they're drilling into something which looks good. Or maybe they're in talks with whoever or whatever entity that thinks about acquiring it. So for all we know, value might be increasing today for, let's say, half the juniors or some part. But it doesn't matter, the market doesn't think about that. But if we think, we're buying company X in 1 year or 2 years, we have to keep, that's how you make the big money, right? One usually can't make big gains. Everybody's, as you see, always focused on the next news release and what the reaction was to the, today's news release or whatever. You can't, if you want any hopes of getting, 1, 2, 3, 4, 5, 10 plus bagger, it means that you have to hold through, 5 to 50 news releases in a row. And the average, let's say, impact of the news release is, a net positive. So, take Great Bear. Let's say after the discovery, you held it for 3 years, I think, maybe, and you got a 10 or 20 bagger. How many news releases did you have to add together, stack up, which you held through, and receiving the impact of all those combined? 50? Maybe. So if again, it's like you can't make a 10 bagger out of one news release. So that's the thing. So if you're constantly flip-flopping whatever, what's your holding period? 1 day? One news release? That's how most people, the time frame is people jumping from junior to junior trying to get the next positive news release, hot money, or the next, momentum trade. That's not how you get big gains, obviously. But if you hold a story through, let's say, most impactful is a discovery story. If you hold it from discovery to, big increase in, or, multiple, let's say, resource increases to whatever, development even, that's obviously how you get the big ones. It's like Lundin Gold. They weren't in production when that journey started. But now they're in production. But imagine the amount of news releases you would have to hold through in Lundin Gold to actually get a 20 bagger. A lot. And as we've seen, as I talked about in another video, we're starting to see a lot of news come out before Beaver Creek. I mean, my inbox yesterday was kind of full of news. I thought it might be, one of those announcements from 20 companies that these are participating in some online whatever, and they will get tagged. But it's like, no, plenty of news. That's what I talked about. Most people, especially the ones that are going to Beaver Creek, they want to, save, let's say, the best stuff for close to Beaver Creek, so they have not something new, fresh, and positive to talk about. It just makes a lot of sense. Whereas you have a story that's not, had a news release out for since the last Beaver Creek. I mean, how many people do you think are going to be excited about that? How many are going to want to crowd that CEO and ask, I saw this non-news release, it just makes sense. And there's obviously, there's a bunch of, high-risk juniors out there. We're still waiting for maiden assays, I guess. Could also, well, it's not maiden assays, but Tectonic, we're going to look at that later. They put out a news release. Blackrock Metals obviously has been one of the harder stores, but you can tell also now, how quickly. Well, now we're all waiting for results, but it's like when the sector gets hot and we see developers, etc., breaking out, all of a sudden Blackrock Metals, which is like the purest version of alpha, play the risk. At face value, they don't have a single ounce in the ground. They have a very high threshold for success. But especially in a non-hot sector, it's like the idea that they might, be onto something exceptional. That goes a long way. And I think Rackla was actually up a bit today. I've actually given that, okay, gold price has just kept on rocking, etc. And Rackla has done, very well. Actually, maybe went up more pre-assays than I thought. I've taken some money off the table, value shuffled a bit to advance plays, etc. And none of the exploration stores, none of the positions are big enough to kill the portfolio. And I'm more likely, it's like, take these for example. I have positions in Rackla Metals, Phoenix Metals, Westward Gold. None of them are huge on a percentage basis. I mean, I think they're they're pretty big in a sense, but it's like maybe 1-2% max. I would think maybe not even that in most early stage pre-discovery stories. I'm much closer to, or I'm open to adding if they actually make a discovery. The way I look at it, it's like, okay, if I have 1% at risk, if they totally fail, assume minus 50% and assume that's permanent in the sense that, most of the early stage exploration plays, they have projects, Rackla is probably going to have money after this drill campaign. Phoenix has other targets. Westward Gold also has other targets. Maybe not a lot of money, they would need to raise, I think. But for all intents and purposes, assume at least you're going to get minus 50%, and that's like a monetized loss. Unless you stick around and a year from now maybe they do make a discovery and all of a sudden it's a success story. It's like the gray mining, for example, which became a $5 billion takeout target. What was it, like 12 months ago or something? That was dead in the waters. That was dead in the waters after the Pilbara conglomerate gold story. All the companies involved in that, when sentiment, the tide, tide ran out, etc. The gray was crushed, like most stories, like Novo and what were the other stories names? I don't remember all of them. But then all of a sudden they found something, and then it went up 40 times or something. So there's always, I mean, as long as a story is live, there's always a chance for a comeback. But let's not just assume that's gonna be the case. And instead of, I mean, there's stories that, let's say they drill a flagship project, they miss, and the story is killed, and it's going to be 3 years until they actually can drill another project and add the dilution, yada yada yada. So I'm just assuming it's like, I mean, yeah. So I haven't decided. It's like when people ask me, do you with some companies, what's your target price? I don't have a target price. I don't have a target price for any one of my holdings, really. And I've said it before, I don't believe in rules. I said it at the conference when I was at a panel in either it was Atlanta or Fort Lauderdale this year on Phoenix conferences. I was asked, do you have any rules? Like, I don't have any rules, because I can't possibly know what the news is going to be for companies, or what the share price is going to be, or what the gold price is going to be, or what the sentiment is going to be, or what the relative opportunity cost is going to be. So I mean, if I have a target price, I mean, that's kind of assuming that, well, nothing is going to change at all. But what if you have a target price and then all of a sudden the company does something, or a discovery is made, yada yada, and it's like gets, the risk reward increases by 300%, and I'm, my initial target price was 50% higher. So like, should I be selling that? No. So it's like, it's a wait and see. I just, like, which I said, I think on the K report, or maybe, yeah, I think I said that. I just wanted all of the holdings I have. I can see that there's a way that in 1, 2, 3 years or more, or I mean, tomorrow up to whatever, 3 years, they could be worth a lot more. That's it. I want to have a wide berth. I want them to be open-ended. I want a store that I'm buying where it's like, okay, they have a big pipeline, or a lot of exploration potential, or they might ramp up production, etc. And that usually takes some time, right? You don't go from initial discovery, or I mean, even the Great Bears and the Lundin Golds, they take years to develop. But if if you can see that, okay, over the next 2 years, there's a chance that these companies, some are even starting off cheap, they can be worth a lot more than today. I mean, isn't that kind of good enough? I mean, I don't want precision. I want, like, okay, this junior. I mean, take Red Canyon, for example. I forgot to put it on here, but they have a 10 million market cap, right? They're about to close a financing with a multinational. They have a huge target at Kendall, porphyry target. They have some other huge targets. 10 million market cap. They're probably going to start drilling soon at Kendall. Do I know they're going to hit? No, but from 10 million market cap with a multinational, which basically, proof of, or vote of confidence, or third-party validation that yes, their project have $1 billion plus potential. Does it make sense to have a target price? No. I mean, I think it's a pretty simple case. Good people involved, third-party validation from a multinational. If they hit something, especially if they hit something significant, my base case is that it's going to be a lot higher. That's it. I mean, that's good enough. I mean, 10 million market cap, a multinational would only be interested if they see, $1 billion plus potential. I mean, that's a pretty simple story. It's like, okay, odds are they're not going to find something of significance, but if they do, it might be, 10, 20, 30, 40, 50 bagger. That's a pretty simple case. There's no rules or target prices or anything. I just want obvious cases. Or you have some, we're going to look at later. Let's say AMX, for example. On paper, they just put out a PA. On paper, at today's gold price, their project has an NPV of 1.8 billion. The market cap is 370 million. There's some room there. And even though that's been performing very well lately, but to me that's pretty, pretty good margin of safety still. So it's like, I don't know if it's going to be sold at 1.8 billion or is actually worth 1.8 billion or what the gold price is going to be. But it's like, am I in a rush to, let's say, sell the position because it's up? No, because I think more things can still go right than wrong. And it's not like I'm pricing in that, yeah, it's as good as it looks, for example. Because on paper, there's, $1.8 billion minus 330 or 350 or 60 million price to value difference still. That's undiscounted, so it's not net asset value because NPV assumes that this can start getting built today, for example, which they can't. So it's like it's not true value in that sense. It's what the project theoretically is worth, but it's not true value. My point is that's why that's why I never sell. I just, if my portfolio, if I think the holdings are cheap, or that, let's say, you don't find anything that's cheap with margin of safety at whatever point in time, but at least you see that, okay, maybe you have a bunch of high risk plays where it's like, okay, they don't have anything, so it's not cheap at face value, but I see how they could make a discovery, whatever, and be worth a lot more within 3 years. In that case, like, there's no reason for, so far, again, I've been fully invested since 2015. Because I always think that every holding I have, on average, the risks are to the upside. That's why I'm not good at selling. You never know which is going to be acquired, let's say, or what's going to happen, or you can never know what an asset result is going to be like, or how big the project might be. I just want that to not be priced in today. I hope it makes sense. This is kind of cool. Gold spot versus total gold ETF holding. So gold price has totally dislocated from, let's say, the ETF demand of gold. So it's not ETFs driving it up, and like some people have said, well, that means it's probably central bank buying. That is not the investors who are global investors, whatever, really, or I guess Western investors, that are making the gold price go up, because they don't seem that enthusiastic still. And that's also, in that case, a good sign, and I think that also points to the fact that I don't think sentiment is that, crazy high in a sense. Because what happens if these guys get involved? I mean, if you look at, okay, maybe the correlation or relationship changed before this, but like, one would think that based on how this looks, one would think that the ETF holdings would be up here. But it's not Western investors that seem to be driving up the gold price, because they're not really buying that much gold. The question is, what happens if they join? Because I just assume that the central banks are buying gold now. I don't think they're buying to I don't think because they plan on dumping it in 3 months or anything like that. So that might be really, really sticky hands. They might sit on that for at least 10 years. You don't know, but this is, I think, signals again why there's no real rush in, let's say, juniors or anything like that, because the Western investors are not in really that much yet. Yes, gold ETFs or Newmont has done well and all that, but like, I think GDX and GDXJ, I think they have had still net selling this year. So, like I talked about in the last video, I would expect that a major top is going to come with euphoric sentiment and euphoric valuations. We are nowhere close to euphoric valuations. That's why it's still so easy to find cheap stuff. That's why I'm still holding and buying as much as I can. While looking at GDX, that's near the 2011 highs. Am I enthusiastic about buying GDX? No. Because I don't think, how Ignico is one of the best gold company in the world, but is that super cheap? Maybe not. It's not like, oh, it's a no-brainer. I'm getting, you know, a severe sentiment discount. I wouldn't really think so. But I think again, it's like the junior sector is basically barely started. I mean, people who have been in large majors, they've been enjoying a bull market for quite some time. If you're strictly in juniors, I mean, it's not been that much of a bull market so far. It looks like, you know, a typical bull leg in a sense. So I think there's again plenty left to go. Nothing special. Oh, so one that's been very interesting, and you know, I talked about Altamira before, and I've said, you know, on K report, etc. Just explained, it's like Altamira, nothing really changed for Altamira over the last 12 months. Altamira just discovered more and more targets, but they didn't really have much money. They weren't really drilling, and I think the market was front running the, you know, that the next material news release was going to be a placement. And in a shitty sentiment environment, nobody gives a shit about target generation. Again, at sentiment lows, nobody cares about potential because there's a risk in that, obviously. And people don't even, you know, people think a bird in the hand is too risky. So nobody's gonna give a shit about target generation, grassroots exploration. That comes at the euphoric highs when people are looking for excuses to buy risk to the upside. They will grasp onto anything. You could put out, I mean, just remember the lithium sector. Just staking a lithium project had some, you know, previous gold juniors go up 100%. Because the very idea that there might be lithium there had them up 100%. Whereas, like, if they put out actual gold assays that were good, they probably wouldn't even get a lift. So in that case, the sentiment was so hot that just the tiniest risk or excuse to buy anything with lithium was, you know, jumped on by Mr. Market. So the end of the risk curve are the ones that are going to go last. And sometimes, I remember, you know, Garibaldi Resources, for example, when sentiment was really high, I think they reached a 400 or 500 million market cap before an assay result was out. That is high sentiment. People were willing to pay up for the potential of upside. So you're over discounting, overvaluing potential. At the lows, potential doesn't get priced in at all. Anyway, what was I talking about? Oh, so yeah, so Altamira was stuck in. I mean, let's look at. We can see the share price here, for example. Oh. Yeah, so I mean, a steady downtrend basically. Does that mean that their projects became only gone down in value since 2021? Well, gold has gone up a lot. The amount of targets they have has gone up a lot. They made a discovery. They doubled their resources over this period of time. But still, share price went down a lot. So is that necessarily like 100% tracking with fundamentals, the fundamental value? No. But especially over the last year, everybody assumed that the next thing was going to be a financing. That happened. When did that happen? Well, not too long ago, at least. So it was kind of left for dead because nobody saw any risks to the upside. And because there was no drilling ongoing. And the trend was lousy. Sentiment was lousy. And despite the fact that they recently still had 1.5 million ounces of resources, nobody cared. And all of a sudden, sentiment gets a bit better. People are starting to, because that's the funny thing, is like when stuff goes up, people find it to be cheaper. But Altamira has had now new, I didn't even know, and as far as I can tell, they didn't even plan to drill a hole this deep. Here you can see these are previous holes at Maria Bonita. And we just learned that they had drilled their first hole after they did the race, hole 32. And this is the geological description. You can see here other holes nearby, 140 meters almost of 0.5 grams per ton, 59 meters half a gram, 230 meters 0.8, including 146 meters of 1 gram. I mean, this is obviously a really, really good hole, especially since the metallurgy seems to be really good, starting at surface, so it's like no strip ratio. If that's good metallurgy, I mean, this should be making a lot of money. And then we have hole 32, which is more than, I think, double the length, and it looks like it's 534 meter long, I think, and about 500 meters appears to be in quartz porphyry, which is, for all intents and purposes, the main ore zone, the host rock you want to see. So from a visual perspective, if somebody said, how would you like a 534 meter hole to look like, it would pretty much be exactly like this without knowing the assays, right? Because if it stopped here, well, then it can't be better than this. If there's nothing here, well, then it's not going to run. But if you have 500 meter, that opens the potential for this to be a very wide intercept starting almost at surface with open pitable grades. And here we have comments. This early deep hole at Maria Bonita could really open things up. Alteration veining are as intense or even more so than nearby shallower holes. Although assays are needed to confirm grades, we may be seeing a major discovery unfold here. So I think in the news release or Michael's comments, they mentioned that this hole averaged around 4 veins per meter. And there's a debate. I mean, I think they call it porphyry. Altamira calls it a porphyry. Quinton talks more like it's a reduced intrusion related gold system, like Rackla, like Snowline, like Sitka, etc. And if you remember, and I've had that in my Rackla piece, that Craig Hart said that, you know, typically you'll see 3 to 4 veins per meter in a reduced intrusion related system to get around 1 gram per ton. Now, again, the caveat being is like, is this, you know, a porphyry, should we treat it as a reduced intrusion related gold system? If we treat it as a reduced intrusion related gold system and it's averaging 4 veins per meter, according to Craig Hart, then one might expect, you know, up to 1 grams per ton. And if you roll out a hole here with like 400 meters of 1 gram per ton, I mean, that would be a crazy hole, especially with how good the metallurgy is that is starting at surface. I mean, obviously open pitable, no idea what the strip ratio is. And as you see in hole 29, for example, I mean, that looks like it's ending in porphyry or the intrusion as well. So it's like, what happens if you deepen these holes? And that's what makes this interesting, right? What if, I think they're, you know, the next hole will be deep as well. They're trying to kind of go after the blue sky picture. So a lot of things could change for Altamira in a short order. So again, and you know, alteration and veining are as intense or even more so than the newer. So what would a good result be here? I mean, we can look at, for example, Paracatu. That's Kinross Gold's flagship mine in Brazil. This is a presentation from Kinross from 2005. I mean, it's almost hilarious how it looks like you're at a, you know, what's that old browser? You know, whatever. So this looks like, well, it is, I guess, early 2000s. But I mean, it's like you can see the pixels in the Kinross logo. Anyway, so this is a huge deposit, low-grade deposit, and you can see some of the holes, for example, 69 meters, almost half a gram, 60 meters, half a gram, 99 meters, half a gram, 111 meters, almost 0.6, 80 meters, 0.6. They're producing 500,000 to 600,000 ounces per year. It's a different type of deposit. Here's some other stuff, but it's like they're making a shit ton of money on this today. That's, if you look at Kinross' presentation, this is the first mine they cover, so this is seen as their flagship. And here you have, I mean, this is a very wide and thick but low grade deposit. It goes down, and here you have the pit limit, for example. I guess that's done at $400 gold, because this was some time ago, obviously. But they're making a lot of money on this. This is a real money maker with these grades. And as far as I can tell, it appears that the metallurgy is better for Altamira. Preliminary looks better, so they should lower costs. But all else equal, they would make more on the same grades than Kinross. But obviously Kinross, that mine is of such huge scale, so you get economies of scale, etc. But I would say that the threshold for success, obviously less, the better the metallurgy is. Starting at surface, I mean, here it started at surface way back, but it's not at surface today. I would assume they just keep increasing the pit. And here's from a old news release what I looked, and again we don't know. We don't know what the answers are going to be. This is hole 29. And here you see like a pretty long stretch of good mineralization. Here's hole 15. I don't know how far away that is, but it's not like, I mean, when you look at this, like there's almost, and these holes, as we can see here, I mean, wait, 13 and 29. So here's 13. So yeah, I mean, all of these holes bottomed in. There was some mineralization. I mean, they didn't stop because there was no mineralization. Right? Even here it's like 0.3 to 0.5. I mean, the cutoff grade at Perca 2, I think, is like 0.14 grams per ton or something. So, I mean, if you just look at Perca 2, this interval here is still like 100% higher than the cutoff grade, even though this is a low grade section. So what happens if you, I mean, I had a slide, but I don't think I have it up right now. But so this is hole 29. That looks long, right? I mean, the hole they drilled now is more than double this. So what happens if you put down 530 meter holes all around here? Because as you can see, open, and it's only the later dike here that appears to be barren. Everything else basically appears to be mineralized. And if the cutoff grade is low enough, I mean, if you just find a big effing smoke, cloud, I should say, cloud of low grade, that might turn into a really good mine if metallurgy is good. Because look at the strip ratio, there is none. So, I mean, they have 700,000 ounces at Maria Bonita right now. And this hole here kind of shows that, well, there's at least twice the depth potential, at least where they drill this, right? So what happens if they start do they have a, okay, I don't have a cross section, but okay, they don't have a cross section, but, or do they? No, apparently not. But what happens if you start to put in 500 meter holes here? I mean, if you double the resource, because we don't know what the grade is going to be on this hole, but we know it's close to this one that had 0.8 grams per ton. So, and the average resource grade, I think right now is like 0.45 or 0.48. So maybe grade and tonnage, will go up with this. And what happens if they start doing 500 meters hole? I mean, which is the great part about these types of deposit. A few holes can kind of infer a lot of tonnage. So if they just double this resource, for example, that's already 1.5 million ounces at Maria Bonita, and they have 700,000 at Cajero Central. And there's plenty of upside left at Cajero Central. Drilling to expand mineral resource, advanced metallurgical test, bulk sampling on near surface, advanced drilling to expand. So, I mean, it's not going to take that much, I don't think, to get this up to, let's say, 2.5 million ounces for the Cajero project. And this is pretty close to here. So 2.5 million ounces of economic gold in an area with good infrastructure, probably relatively easy permitting, etc. And we know they have Aura minerals already in, and Aura minerals are not even they're not explorers. I mean, if you watch presentations by Aura Minerals, and I've talked to them, it's like they're not explorers. They are a multi-mine producer. They have mines in Brazil, but they're not speculating typically on exploration. They don't do much exploration themselves, I don't think. So when you see them, come in again for money, and they've already been in Altamira, I mean, to me that suggests that one of the companies that would be the experts in a sense of, let's say, getting low capex projects into production in this part of the world, Brazil, South America. They're saying that they think this is going to be is mineable and going to be a mine. And I don't know how much they care about the exploration potential, but just to have that as kind of third party validation that they think there's a bird in the hand already, then that's what makes the risk reward, in my opinion, of Altamira Gold with this hole very interesting, because for all we know, Aura Minerals already thinks that, I mean, they have 1.5 million ounces in total, and obviously that's a high likelihood of increasing. So let's say we get up to 2 million ounces. I mean, to me, I think Altamira already has something basically, or very probably something that's going to be a mine, is mining worthy, and with this hole, it's kind of breaks up the blue sky potential. Plus, then, we fast forward, if we think about again how many, if we want like the really big gains, we have to hold it through a lot of news releases. Then they have all these other targets. I mean, Novo Sonio is even larger at face value, at least, than Maria Bonita. Cajero is, I think, pretty much wide open. You have Tavares Norte, Guillermo, Moroverde, and like Quinton says, that he believes these might all be, the same type of systems, and they even have that here, that conceptual model that Cajero Central, that's high up in the system where there's more veining. Mombaque, which is here, is, I mean, that everything is tied to different porphyries or intrusions. That you have a cluster of intrusions, reduced intrusion, or porphyries sticking up here. So what if we can kind of see that, okay, they should at least have 2 to 2.5 million ounces, let's say, with some more drilling. That's like, the probable bird in the hand. And that's excluding all these other targets, and excluding that, let's say, Maria Bonita really becomes they start hitting on a lot of deep holes, for example. And if we fast forward, let's say 2 years out, they have a resource of 2.5 million ounces. They made some more discoveries. They're more closer. The idea is that, okay, they might have 3 to 4 million ounces of, let's say, very economic open pit, mineralization. I mean, then we're really talking. Then that's a pretty rare multi-million ounce system in a, deposit or deposits in an area where you could probably, relatively easily actually build a mine as well. Then who knows? Maybe we're talking like 100, 200,000 ounce per year potential, and that might still be wide open. So it's like, within this picture, we have no idea, but I think it's likely that there's at least 2.5 million ounces here. And if you account for all the projects that haven't yet been drilled and will get tested, what's saying that there's not 5 million ounce potential here? Are we paying for that? Absolutely not. I mean, just look at some open pit, pretty straightforward metallurgical projects out there with 1 million ounces or something. I mean, at these gold prices, they're worth a lot. I mean, I own Sonora Gold, for example, and Tokwan. I mean, Sonora Gold has, the capex is like 30 million. This might not be heap leachable, so I would expect more capex. But that NPV at today's gold price, I don't remember what it was, maybe 500 million or something. And that's based on, I think, just 500,000 of resources. So it's like, this is at face value. Altamira's been a very boring story lately. This looks kind of boring because it's not like the Flash's grade. But again, it's like a Perka 2. This is Kinross flagship mine, so it's like, and again, I don't think one could almost ask for a better third-party validation than Aura Minerals. I mean, their competitive advantage, if you will, is, I mean, they're experts at evaluating profitable gold deposits in this area, which they think are mining worthy, but not necessarily, let's say, tier one. I don't think they want to. I mean, their whole thing seems to be get 1 to 2 million ounces, 1 to 2 million ounce gold projects up and running. And we have, for example, today, Altamira's gone down a bit in price, and there's warrants at 20 cents. I mean, I discussed this with some other people, and and I said, I'm very excited about this deep hole, and I've been buying, and they kind of were surprised, like, given the volume and all that, aren't you more likely to sell? Because all of a sudden the stock is up, and that's typical, the rule of sell half on a double or whatever. But like, I mean, I think this story might have a really good turn for the better, because that was the biggest question mark so far. It's like, is there scale to Maria Bonita? Because they hadn't even tested it really that deep, and all of a sudden they put a hole in, and they keep going because they're still in the porphyry or the intrusion. So again, from a short-term perspective, I mean, are you buying high? Yes, you're buying a lot higher than it was. Well, a lot higher, but 100% higher than the average was over the last 6 months. But what is the value of this, news release, and how cheap was it to begin with? If this makes it a shot at like 2 to 2.5, 3 million ounces of near-surface gold with good metallurgy, that could be worth a lot more than 66 million. So let's say, my point is, I'm not buying today because I necessarily think it's going to be higher tomorrow. I'm buying because I think with this news release, it opens up that there's going to be a lot of other interesting news releases from Maria Bonita, and that the whole pie might enter whatever tier 2 territory in the future. So I mean, and there's been quite some appetite. I mean, I thought 24 cents was going to stop it, because someone or some people basically put up a wall like this, but even larger. No, it might have, even larger, I think, but it ate that through to yesterday. So there's warrants in the money at 15 cents and 20 cents. And that's the thing, which, like, most of the time people complain, you want really clean share structure, not a lot of warrant overhang. They want like 64 million or 264 million, etc., etc. The flip side of that is that when you have that kind of artificial selling pressure, artificial discounting, that also means that some stuff is kept cheaper than it should be. So in this case, I mean, I added for the family portfolios as well, because I don't think, I mean, if this hole turns out to not be much, I mean, that does not kill the story. That's one hole, but it has the potential, in a sense, to really kick this story into higher gear, because they still have 1.5 million ounces. That's not going away, and the gold price is in fact at 3,600 or so. So I like this as a, in my opinion, relatively low risk, and especially with third-party validation from Aura Minerals suggesting that they think they have something that's going to be a mine already. That makes this, at face value, to me, a pretty low, medium risk, high reward scenario. Because if this picture really develops well, then this could be a major mine, let's say, and in that case 66 million is just not gonna cut it. I mean, if in time this turns out to be 3 million plus ounces, and they put out a PA one day showing like 2 billion plus MPV. I mean, you can do the math. I mean, it's probably not going to be trading at 66 million. But again, that has nothing to do with what the share price is going to be tomorrow. And again, 1 day difference is like it was for a. It hit a low 22.35, for example. I mean, it was down like 12% compared to yesterday. Why? I mean, it's perfect in the sense that warrant overhang. People are all of a sudden in a profit maybe, and you have today's sentiment which is gone down a bit. Maybe some people front running the Crescat. Quinton is going to talk about it tomorrow. Yeah, so I mean, again, what happened? I mean, yesterday it was trading at whatever or closed at whatever, and at some point today it was down 12%. Was there any news out in between? No, nothing. It's just sentiment, short-term trading, warrant overhang. So there's a bunch of stuff going into it. So I mean, I was kind of glad to see the wall at first 24 cents. Because okay, this might keep it capped, so it allows liquidity, so you can accumulate. I mean, if this was a super tight share structure and there was no warrants, maybe it would have jumped 30% more or something like that, and you wouldn't get the chance at least to have any meaningful size to get in. So it's like that's not always bad. It's I mean, there's some stocks out there, for example, that are so tight. It's like, how are you going to get a position with any meaningful capital when there's like 4,000 shares out for sale or something like that? And that's obviously what a lot of, let's say, hot money and Twitter pumpers, etc. They love the tight share structure, and usually they don't manage that much money, so they can get in and out of these low liquidity, which are relatively easy to move. But if you actually want, I mean, I talked to a guy once that I heard he, I don't know, has a lot of money, and he was complaining that there's not enough liquidity in like First Nordic, for example, which is averaging 500,000 shares per day. I mean, to me that's crazy that that's not a lot of liquidity. But it's like when you get big money, all of a sudden some of stuff like warrant overhang, etc. I mean, that can be pretty good if the story is intact and all that. So I mean, I would I would classify this as I mean, it's certainly not as high risk as Rakla, for example. Rakla could have something. I mean, the potential, the idea, the win condition is that they have something exceptional, right? That's the win condition. Altamira probably already has something that's worth mining, like actual value, monetizable value. And if there's a PA done on that, those 1.5 million they have, I mean, I would think there would be at least several hundred millions in MPV with not high capex. So I think they already have a bird in the hand. It's not a tier 2 bird in the hand, but I think they have potential for a tier 2 or even tier 1 potential. So that's why I think the risk reward is very favorable. And I think the risk reward changed quite a bit with just these visuals here. And what's success here? I mean, if they come out with like 400 meters of 0.8 grams per ton, I mean, that's huge. I don't want to speculate that they would get more than that. But like if they 200 meters of 1 gram per ton, I mean, this might be a really good open pit story. And what happens if they deepen some, because again, as far as we know, it looks like there's a lot of gold in this very old intrusion, and it what was I gonna say? But as you can see, I mean, it's complex, it's complicated. You have like here it blows out in grade, here you have 0.5 to 1 gram per ton, here you have 0.3 to 0.5, but it doesn't look like there's anything really that uneconomic except well, maybe this part here and the later the post mineral dike here that's barren. And depending what the cutoff grade is, etc., no, I think if I had to guess, I think there will be a mine here in Kajura Central one day. And that's not a lot of juniors that can say that for their projects. Most have projects are too bad, or at least not good enough to, for the to pay for the infrastructure if they're remote, and or that they're in a place where it's very hard to get a mine up and running, etc., etc. So yeah, I'm pretty sure this is Altamira after the run up and some additions. I think they reached. Pretty sure they reached top 15 in the HODL folios. Again, I haven't updated the list on the site. Another one, not exactly, somewhat similar. Tectonic Metals announces It is exciting to see the companies generated a large inventory of promising drill holes this season. Clearly, many new areas of sheeted veining are being uncovered. If assets confirm strong gold grades in these holes, we have full confidence that the flat project's ability to host a world-class reduced intrusive gold system. Swing for the fences. It's not. This is, in my opinion, much more high risk than Altamira, because they don't have anything that. Right now, they don't have anything. I don't think. Well, they don't really have a resource yet. I mean, they're working towards that, but the threshold here is much higher, I would say, than for Altamira, for example. So you need more for it to actually be monetizable. I mean, if you have 1 million ounces, for example, here, which is quite remote Alaska, it's like that's not going to work, even though the metallurgy looks good. But this news release very promising in the sense this is Alpha Bowl, and note, I mean, that's, I'm not going to say a trick, but obviously you tend to, or companies and presentation, I mean, they lead with, I mean, Chicken Mountain was the, origin, or the known, not known quantity, but it's the, don't they have the, okay, maybe we have to do it like this. Chicken Mountain is like, I'm not gonna say proven quantity, but why aren't the actual, I'm pretty sure I saw a bunch of slides. Okay, let's look at the. I mean, Chicken Mountain is where the most historic drilling has been, and then you have Alpha Bowl. Here, which is here. So here you can see. I mean, I thought this slide is probably in the news release somewhere. Here is diamond drill hole, RC drill hole. The black ones are historic. So there's some holes here, but you can see there's like, okay, most of the holes have been done at Alpha Bowl. And if we look at the news release, that's the target they're leading with. That's first, before the other one. So that suggests that's the one they're most excited about. And it makes sense. There's invisible gold observed in a number of quartz veins, multiple generations of veining, including sheeted, brecciated, and late-stage carbonate veins. I mean, that's what you saw at Snowline, where there's different vein orientation. So let's say you have one generation that, I'm talking about core valley here, where you have one vein generation maybe making it up to 1 gram per ton. Then you have another. All of a sudden you have 2 grams per ton. So it's like overprinting. Yeah, clear structural overprinting, cross-cutting vein brecciation, faulting, strong sericite, potassic alteration, and do we have any? Not any real cross sections. Okay, so look at this scale bar here. That's 500 meters. So they're testing 5. I mean, I think they've uploaded a bunch of the pictures, but I mean, the size of valley is like, I guess, this big. So like what they've drilled here at Alpha Bowl is kind of the footprint of valley, for example. So it maybe doesn't look like much, but it's like the scale here is pretty enormous in a sense. So if they have like, a lot of these holes hit, I mean, the inferred tonnage could be quite high, and we don't know the grades. I don't know the exact threshold for success. We know what's the market cap. 110. I mean, is that pricing in that there's a 5 million ounce economic deposit here? I don't think so. So that's one of the many early stage exploration stories I have. And then I mean coming back to the idea that's like, do I need to know exactly? Do I have a target price for Tectonic? Absolutely not, because I have no idea what the assets are going to be. I mean, the only thing I know is like, if this for some reason turns into a 5 to 10 million ounce plus economic deposit, yada yada, it's gonna be trading a lot higher than this. When is that gonna happen? How long will that take to prove? I don't know, a few years. But most people are, again, like always guessing, oh, what's the next? Usually, when is this gonna go up a bit? When am I gonna get a 10 bagger? You're gonna get a 10 bagger in 2 years maybe, if things work out. 2 years, but you're gonna have to hold through a lot of them. Yeah, so this is obviously on the watch list. AMX per gold project delivers strong economics in up to the PA. Post-tax NPV of almost 1.1 billion at $2,500 gold price. IRR of 70%, which is incredible, especially since, I mean, what's the market cap right now? 350 million, and at $2,500 gold it has an NPV of almost 1.1 billion, 71%. So that's quite some margin of safety to a gold price that's $1,000 lower, and it would still be on paper worth around 3 times the current market cap, and gold is in fact at 3,600, not 2,500. So that's what I like. Again, it's like there's, let's say, room to grow into the suit. I don't know if that's how you say it. For all intents and purposes, I think the risks are to the upside. I mean, why? Because simply it looks like the value of this thing is a lot higher than the market cap. That's it. Simple as that. And that's without any more exploration success. And I just pointed out in this, and I'm not saying it's going to be a $2 billion take-up, but this is what I put in the Amex report I did. That's like Lamac, which was owned by Integra Gold. They get acquired for a 62% premium to the PA and PV of their project at spot gold. Spot gold was 12.55 or something at the time. Their project had a NPV of 363 million at US 1,250. They get acquired for 590 million. So Eldorado paid in 2017 590 million for a project that on paper was worth 363 million. Obviously they believed there would be more upside, or betting that gold was going to go up. Today gold has already gone up, and now we kind of have the opposite. I mean, it's almost okay, not half of it, but it's like it's trading at 60% of what Integra Gold was acquired for, and Amex Exploration at face value is worth twice what Lamac was valued at the time. This is what I mean. I think there's a lot of room left to run in this unit. We're not even close to euphoric valuations. I mean, imagine if you would have a buyout of 62% premium to Perron's NPV at spot gold, which is like 1.8 billion. I mean, that would be like, close to $3 billion. I'm not saying that's gonna happen, but it's like, if you just compare this apples to apples, this would be like Integra or Eloro Gold buying Amex today at like $3 billion. And then, I mean, it had a run up, and of course, I mean, everybody knew that a PA was coming, and and especially since Beaver Creek was coming up, and then probably that meant that there was a lot of pent up selling, that people like, okay, I'm gonna sell when they release the PA, because again, most people chase a one pop on a news release. And today we have, somewhat bad sentiment and all that. And maybe some complaints like, okay, buy the rumors, sell the news. But it's like, in a sense, like, who cares? If you bought it yesterday and you were planning on selling for a 10% pop, and it's like, sell now at minus 5.5. My point is that I am in no rush to selling this, especially the entire position in the HODL folios, for example, again, because it looks like the project might be worth a lot more than the current market cap. And you have to hold long to have some big gains. I'm not chasing one news release things. It's like if Rakla were to hit something massive, for example, if it were to hit, that would probably be the start of something. If Altamira hits something that's really good, I mean, most people are, again, they're excited about the next news release, but that's like missing the forest for the trees in a sense. I mean, if Rakla, for example, and note that I've taken some money off the table. I actually put some of it in Altamira, and I don't know what Rakla is going to show. Maybe I'll have, maybe they'll come out with 300 meters of 3 grams per ton, and I'm going to feel like a dumbass. And maybe Altamira is going to come out with 300 meters of 0.3 grams per ton, and I'm going to feel twice like a dumbass. I sold the winner and bought the short-term loser, for example. That's always a possibility, but like that's still not how you make the big gains, right? You're not gonna these snow lines and all those that were discoveries and became 10 baggers, Great Bear, Snow Line, I'm trying to come a collective mining, yeah. They became 10 baggers from holding through, like, if you held them through 30 to 50 news releases. But most people are chasing the very next news release, because in their mind they can print money forever if they just are in every news release. It's going to be a positive, and then it's going to go up. And I mean, the idea probably for some in AMX was like, okay, now they've already had a run up, so it's like AMX has been delivering a lot, so who cares if it sells off on the PA in a sense. If we're talking long term, if this PA is in fact close to the mark, it's going to go up. It's going to go up. It's going to go higher over time. But if you bought it yesterday, knowing that the PA is going to be put out, because in your mind you're like, I'm going to make 10-20% in one day, then I'm going to find another one and do the exact same thing, because then you don't have to wait for anything. You just buy every imminent expected positive news release. So in theory that sounds great, that you'll just jump and make money in one day intervals. Like, okay, you made 10-20% today in AMX, then you sell that today and buy another one that has a news release tomorrow, and you're going to be up 20-30. So I mean, in a year you'll be up 50,000%. How many do you think try to do that? A lot of people. How many do you actually think make any real money? No, that's hot money. In a bull market, that gets easy, right? But like, the risk reward is typically not great. I mean, can we complain about this PA? I mean, we already, I guess, in some ways gotten paid for the PA already. And there's probably, again, a lot of people that, just their plan was, when the PA comes out, they think it's going to go up, so they sell. So they've already bought a bunch of shares. Let's say 1 million or 2 million shares get bought in this period, just with the intention, I'm going to sell on the day of the PA. That's 1 million shares that's not thinking about the long-term picture, that just planned to sell no matter what on the day of the PA. And then you have pressure, especially on a day like this. Blackrock Silver receives $4.24 million from warrant exercise and upsizes Eastern Resource Expansion Drill Program at Tonopah West. I mean, this is one of few actually good silver projects in my mind. Why I like this is I don't like too many silver projects, because again, if you look at the gold-silver ratio, it takes around 100 million ounces to have 1 million ounce worth of gold. So in my opinion, still a lot of silver juniors are in fact overvalued. They're all pricing in that silver is gonna hit $60 or something, and gold is not gonna go up. And in that case, maybe the current price, in that case, they're cheaper than gold juniors today. I don't like that. That's speculation. I don't like that. That's greater fool trading. That's speculation, greater fool trading behavior, yada yada. Blackrock has a very high grade project, and gold and silver. It's not actually, it doesn't have really lead and zinc. It's just a precious metal project, kind of like, Silvercrest. Very high grade in Nevada. PAs suggest very beefy margins at, lower silver prices and lower gold prices. So this looks like, at face value, this looks like a project that's simply gonna make money almost regardless what the gold and silver price is. So the upside in gold and silver becomes pure gravy, and it looks, it's still, PA, but it's like, it looks like a robust deposit. This is, compared to most silver projects that will never become mines and are not good mines and really only make, decent money at silver $40-50. But with the caveat that silver juniors do see heavy speculation. But it's like, the point being that if something legit has real value is worth 500 million, and you're buying it for 240 million, that's infinitely cheaper than buying something that's really not worth anything but is trading at 20 million. Even though it's less than 1/10 of the actual price. But if it's not a legit project, then there is no value, so it can never be cheap, no matter how low the price is. That's one thing that, again, most people's like, oh, the price is low, but is it cheap? Blackrock seems to have one of few silver, dominant projects that actually looks like good projects, that this probably would make a lot of money. If you own this personally, you could make money on this deposit. Whereas, like, again, most silver projects out there, they're small and they are not really that high margin, unless silver goes up a lot. And would you, if you had, would you be betting your life works or whatever, all your money on something that could work out if silver was up a lot and kept up? It's like, I don't know about that. And obviously the same goes for gold. There's multi-million ounce deposits out there that are not really that high valued. Why? Because they're not good deposits. They wouldn't become good mines. There's 30 other projects that would get built before that. District Metals Inc. So point is that, like, I'm not comfortable speculating too much on just, that retail is gonna flood into silver names and they're gonna go up and pigs are gonna fly and all that. In Blackrock, I at least get exposure to silver, plus it's like a legit project. When the tide runs out and silver prices go down, this, I don't think, will all of a sudden turn to shit. No, because it is one of the highest grade primary silver projects out there. They do not grow on trees. This is going to be the highest grade, one of the highest grade silver, undeveloped silver projects, regardless if silver is 42 or 25. It's one of the more robust projects out there. So this, I think, actually has value, and maybe a lot of value. And it's in Nevada and, kind of brownfield site. District Metals land position at Sågtjärn property after successful UAV survey in Sweden. The results from our first ever UAV-based detailed radiometric and magnetic survey in Sweden are truly compelling. Known uranium polymetallic occurrences such as Sågtjärn deposit and associated uraniferous boulder fields stand out prominently and suggest the potential for extensions beyond the currently recognized mineralized zones. Additionally, the survey has revealed several new target areas in regions that were previously underexplored or obscured by glacial till based on coincident urinophorous radiometric and distinctive magnetic anomalies. So yeah, radiometric anomalies seen in dark here, and here you have the Sågtjärn uranium deposit. So I mean that makes kind of sense that the geophysics would come up with a radiometric anomaly, oh yeah, here's number 1 and 2. So I mean, what's the scale here? Okay, 2 kilometers. And that kind of again coincides, I guess, with the magnetic, that you have some kind of trend like this or trend like so, and you have uranium readings, let's say, following this the high readings of the magnetics. And I think this is really good for district in the sense that we know that the Viken deposit is absolutely enormous. It's an infinity deposit. We know it's alum shale. And this is also alum shale, polymetallic uranium deposit. Thing with Viken and I mean uranium overall is the idea is like, okay, will you be able to get to mine it because of local opposition, whatever. To have this is like diversification to the upside. What if they find a large or prove up a large deposit here at Sågtjärn? Maybe this is a place where it's much easier to get a mine permit, for example. That at the end of the day, maybe even if there is an alum shale uranium polymetallic deposit that gets into production in Sweden, Viken and Aura Minerals or Aura Energy, they have the most advanced ones and they're super large. They're again billions of tons. But who knows? Maybe Sågtjärn would be the first to go into production because it's maybe much easier simply to permit it there. And if it's there and it's good, yada yada. So I like this idea that, again, because even if, again, let's say Viken is, let's say, more economic than Sågtjärn. But if for an eternity you could never get a mine going in Viken, well, maybe you could get one mine going here. So I like this, again, diversification to the upside. That, let's say uranium is high, EU is screaming for uranium, Viken has a lot of problems and the government is not comfortable, let's say, running over local opposition. Well, maybe it's easier to do that here, and lo and behold, in the future there is a alum shale deposit and it's actually here in Sågtjärn. I hope you get what I mean, but this is obviously just from a long-term actual investor perspective. Did District Metals go up a lot on this news today? Unchanged. Pretty good volume though, but unchanged. So okay, at face value nothing at all happened. But is that true? No, I would say that from a long-term perspective, this de-risks the case, plus obviously increases the upside potential because this suggests that there might be a lot more alum shale here. Then we have Eloro Resources announces closing of 40 million bought the live private placement. Good thing about this, good thing, they get money, obviously Iske is large, and what's interesting for Eloro is the fact that Bolivia seems to be going center right, and the MAS party, MAS party, which is typically leftist, they are getting kicked out basically. So I think this is on the back of the Milei trend in Argentina, and I had no idea that might happen, that okay, they're actually gonna throw out or it looks like a 2-decade-long socialist party is gonna get thrown out, and I would assume more pro-business, more open to foreign investment government might take its place. That's great. Bolivia, the biggest thing about Bolivia is perception and obviously how how to put it. It's not like it's only perception that like Bolivia is super safe and super great, and it's only perception. No, is a high tax country, but also very low mining costs and all that. And I think permitting is probably, I mean, assuming you have social license, probably one of the easier countries to actually permit stuff. But the perception is that it's been as bad as Venezuela, basically. So if that can change, I mean, we've seen what happens in Argentina. So it's like my hopes is that Bolivia is gonna start opening up more, because there's some serious, obviously, as we know, geological potential there. I mean, there's other Bolivian miners as well, and there are juniors mining in Bolivia and companies mining in Bolivia. But it would be great if this opens up things. And I mean, if you have a system as large as Isca, obviously political risk becomes a big deal, right? If you're planning on building a, let's say, multi-billion-dollar project that might be in operation for a few decades, I mean, all of a sudden, jurisdictional risk is kind of big, right? So really good positive. I mean, I'm not gonna say I was, super surprising. Maybe one should have expected something like this after Milei in Argentina, but yeah. So this I think is very interesting for Eloro, and maybe turns out to be making their life much easier. Goliath Resources. Well, this is a video done at K Report. I was expecting even more assays actually from Goliath. They put out obviously recently, as we see here, 22 meters, 10 grams per ton. Maybe they're more in queue and simply haven't received them yet. Maybe there's a lot of people again going into Beaver Creek that's like fast track our assays. But I expect this to be, yeah. I mean, there's shit ton of news yet to come. Just a last look at this is one of the HODL folios for a family member, and I mean, if you look on Twitter, this is basically what everybody makes every year or every 2 years. I was gonna say, and I was what was I gonna say? I mean, I think I think I'm getting better and better each year at investing. But this is it's kind of funny. You can see some of the the volatility. It was like this goes back to also the long term. Let's say long term picture of some cases. If you looked at this portfolio at any point in time since like January 2019, how much of the time would you be excited if you had this portfolio? I mean, this period, 1 year, went nowhere. Then it went down 50% in the COVID crash. Then it took until a year later to actually go up and started trending a bit, and then correction. I mean, at no point really, except maybe here, maybe this, which is what, 2% of this entire chart, is when, and this was, I'm pretty sure this was the Magna run up, since the HODL folio was really big on Magna. That's about the time, and this was the Condor flush. One day is like had in. I think I had. I love the case, but I think I had too big position for the HODL folios even, and I mean that's the biggest loss I have had personally in a day, and I think it was the biggest for the HODL folios as well. But it's like, okay, it didn't end there. Licked our wounds. Big fat minus, but now we're back. But it's like this hasn't been. I mean, it's not going up. I don't know what the average is, but let's say it's. I have no idea what the average is. Maybe, what could it be? Like 35% per year? 40 maybe? I don't know actually. My point is that in hindsight, I'm very happy of this family member having 562% over close to 6 years. But in reality, that looks super boring. I mean, again, look at the consolidations. 95% this portfolio is not making net highs. I mean, when it was exciting for like 2% this run up, and it actually went to a new high, it almost retraced the entire move, and it took until, well, let's say this top is, I mean, it kind of took until now for it to actually come to a net high. So at any point in time when you looked at this portfolio, it was going absolutely nowhere. Most of the time it was, I mean, most of the time in a bigger picture it was going sideways, on a medium time frame. On a short-term time frame, it was as likely as to be going down as up, if we're talking recent trend. It's only years after of just holding cheap, when you look back, all of a sudden it's like, that's a pretty respectable return. And that's why I, have, the HODL folios, for example, listed, because the idea is that since I manage, I don't know, 5-6 portfolios, I can't be, trading that all the time, and I don't want to. And these are like pretty diversified. They have like, many of them have like 30 to 40 names. And still, I mean, without doing much trading, I mean, but just waiting, holding cheap, maybe reshuffle sometimes, and maybe if something happens like, Altamira, okay, Altamira comes out with a news release and most people may be taking profits and there's warrant selling and people having rules like you shouldn't add on a double, yada yada. I'm like, okay, I like that the risk reward in Altamira even more now, so I'll increase that stake even though it's revalued. Why? Because I don't know what's gonna happen next week, but if I hold Altamira for a year or something, I think it has a good potential of being higher. And that's one thing I've actually tried to theorize, brainwash myself in like appreciating what probable solid returns, how good they actually feel, in the sense that if you have a, let's say, a developer or something where you think, whoa, I think this could go up 200% over the next 2 years or something. Let's say that. For most people, that sounds way too boring. But if you find if you imagine and look back at your own historic, if this portfolio would have averaged 200% every 2 years, it would be up even more than this, obviously. So when you think about these boring, quote, boring cases, 200% in 2 years, like, hey, I see juniors doing that in a week, sometimes. So it just sounds too boring. But if you imagine in 2 years, looking back at your portfolio, let's say in this theoretical example, you only own that stock. You look back, it's like, whoa, my portfolio is 200% higher than it was 2 years ago. I think everybody would be quite happy, or everybody should be very happy with that. Because instead, what we tend to do is because we overestimate and overemphasize potential rather than probable, or high potential returns are much more attractive to most people than good probable returns. Because most of the time most people we're looking for stuff that we think could go up a lot within the next few months, let's say. But when we think about it, I think we all know probably quite a few cases where it's like, hey, I think this could double in a year, maybe triple in 2 years, and I think that has a pretty high likelihood, but it's simply too boring for us to hold. But and that was the same. Take Lundin Gold, take whatever. If you looked at the charts, they were not off 95% of the time. They weren't that exciting. They were not making new net highs. But if you come back in 5 years, those charts all of a sudden look really, really good, and you would be excited if you only held Lundin Gold, even if for 3 out of the 5 years it went sideways, and in between corrections, and you actually only had net updates. The portfolio actually just went up in value like less than 5% of the time by holding that stock. But when you zoom out, those net returns, they add up. So that's one thing I would like you to, and that's what I try to start reminding myself of when I feel like, when the sector is hot and I feel like selling something that I think has high probability of being up, providing a good return over the next 1-2 years, let's say. What I stop myself or try to remind myself is like, okay, you have all these, hot picks and microcap juniors that are moving, yada yada. But it's like, how good would it feel like if I held this and it played out like I thought it would play out? If I come back in 2 years and I look in this theoretical scenario, I only had that stock and my portfolio is up 200% over 2 years. Would that be better than what I typically average? I think that would be better than a lot of people typically average, which goes to show, in my opinion, that it's our greed that basically kills our gains. We forego the good probability of making, let's say, 200% per year because we're buying stuff we think has the potential to go up 200% in a month. That I really do believe that, and I think I have some work to do on that department as well. Because at the end of the day, even if you would average 30% per year over the long term, those are phenomenal returns. Absolutely phenomenal. And I think we, at all times, have many cases where we think that's very much possible. And even more than that, let's say 100% or 200% in 2 years of waiting. But we simply don't have the fortitude and patience, etc., to buy and hold them for 2 years. And then we come back and we see that we lost a lot on we were too big in high risk plays, because in our mind it's like, I better get rich tomorrow, I want to get rich quick. And then we end up basically shooting ourselves in the foot because we underestimate the risk. And we only do, again, like I said 1,000 times before, one big mistake I did early on, and done probably a lot of time, is that you buy a high risk, high reward case for one news release. It's like I'm trying to come up with, let's take 3 examples. Let's take Finex, Westward Gold, and Rackla. All of them are maiden pre-discovery plays. Let's say you had a portfolio of only those 3. If you sell everything, let's say one makes it, one has a significant discovery, and 3 years from now it's going to be up 10 times. And we assume 2 of them fail then, and we assume it's minus 50% at least. If you sell the one that actually puts out a discovery hole, and that's the first of, and it turns out to be a significant discovery, so they put out a significant maiden drill campaign, significant assays, which later on will prove to be the early stage of an actual significant discovery also being proved up over the next 3 years. If we sell that on 100% gain, let's say we sell everything on 100% gain, how much did we actually make? We have 60, or let's put it like this, we have 67%. Let's assume they go to zero, the other ones that don't make it, and that has a pretty low probability, but let's assume so. So that's minus 67% in the portfolio from that. The 33%, we sell that after a double. So we go up to 67%. So that's all we have left. We actually lost money, because we sold the only winner we had out of the 3 at 100% return. So, and in practice then, of course, that also, because 100% return, is that high? The idea high risk, high reward. I would say 100% return is low reward in a high risk story. So in de facto, theoretically we were playing high risk, high reward scenarios, but in practice we made we made those cases into high risk, low reward bets. And we're going to be killing our portfolios, because if we keep doing that, we're going to grind our ways to zero. Because if we find, every time we find 3 stories, one works out, we're still losing money if we sell at 100%. And we do that next time, minus 33% that time as well. So we're on the way to zero if we keep deploying that strategy. If we do the, okay, I'm letting them run for 3 years, the winners, then in that case, the one that made it would be up, let's say 10x in 3 years, and would have more than paid for all the other ones, and the portfolio would have done great in a high risk, high reward portfolio of only 3 names, because you actually let the high reward play out. And then it comes back to also position sizing. If we know that's the case, that we have to let the reward run to pay for the risk, then it's like, okay, can we do it in practice? Well, if you start out with a huge position in a high risk, high reward case, they make a significant discovery case, but you can't mentally cope with not selling after 100%. Then I would argue that we didn't think it through, and we had too big of a position when we started out. That's why I mean, obviously, and this is also common sense, if you have a 1% position in a high risk, high reward story, they make a discovery. I would say it's much easier to let that now 2% position run for 3 years than if you started off with 10% and it became 20% after the discovery. Because in a year, that might make up 80% of your entire portfolio. And that is something that would be super stressful. And depending on the risk we take, it also determines how much reward we have to get. And if we can't possibly capture that reward because of the mental pressure, then we have a flawed high risk, high reward strategy, which de facto becomes a high risk, low reward strategy, which de facto means we're going to lose money over the long term. That's why that's, I think, a good sign that if you're in, that's why I kind of decreased most of my high risk, high reward. I used to bet, at some point I think I was in a, had like 25% of my net worth, my small net worth in a high risk, high reward story that bombed out. So I took minus 50%. That was dumb. Because I think I was pretty, I think my thinking already back then, when I didn't, didn't appreciate it enough, that's like, well, I think I had the idea that I hope in my mind, I probably thought they would be up 50% chance of success or something. And in my mind, okay, I think it's going to go up 100%, and then I would be probably likely to sell. Again, long term, that obviously doesn't really work out. You can't be risking 25% of your portfolio on high risk plays, even though you think, oh, it's probably a 50% chance of this being a significant discovery, which sounds way too high if we look at it from a statistical standpoint. And all of a sudden, then you say, if you keep doing that, you're gonna lose money. So that's one thing it took some time to fix, but nowadays I try to kind of take a position. If it's a high risk, high reward story, now they have to be really, really good targets, because proven success is selling so cheap. But if I do it, in my mind, I want it to be a position where I think that I can still be holding it after it doubles. If that makes sense. I want the position to be small enough that I think I could somewhat comfortably hold it after a double without making it a high risk, low reward story in practice for my portfolio. Think about that. If you need to get high reward from high risk, high reward stories, you have to make sure that you're able to capture the high reward of high risk, high reward stories. If you kind of can see that I'm not going to be able to hold this for high reward, then that's a sign that you have too big of a position right now. Even though it might feel okay with the position size you have to fast forward to the scenario of success and see if you can capture the high reward side of it. That's why most of the early stage exploration plays nowadays, they are typically like 1% position size or something like that. And that, I mean, that might change if proven success wasn't selling for such low, and preferably, of course, going back to Pierre Lassonde, optionality. I like optionality. Like the one I talked about today, like Altamira. In a sense, I can see that blue sky at Maria Bonita and their overall district is kinda optionality. Because if I think there's a high probability of them already having something that's worth something, then the risks are to the upside from the exploration. So it's not a high risk, high reward story. That changes it completely. Then you might be okay if, I mean, that determines how much reward you have to get. In a low risk, medium reward scenario, where it's like, maybe, take Amex for example. Maybe it's fair to say that, hey, if this goes up 50% from here, it's okay to take all profits because you thought it was so low risk that take the reward side of 50% is more than, okay considering the risk you took. That, I mean, stuff like that, nobody knows for sure, of course. But in that case, taking everything off the table 50% higher might be totally okay. But if you have a bunch of high risk, high reward stories, if you take returns after 50%, especially if you're going into assay, because, well, this opens up another interesting thing, which I've talked about before. I mean, drill hype. Selling, I mean, nowadays I don't try to encourage too much drill hype because I'm not really usually selling into that too much. I mean, it's not my preferred way of doing it. I prefer to take positions in companies where I'm okay holding them into assays. But take Rakla. It's like, okay, that went up maybe a bit more than I thought going into assays, and then gold went up, and the relative whatever risk reward. So it's like, okay, everything looks good so far for Rakla. I mean, we don't know what the assets are, but it's not like I mean, they might come out with barn burners, we don't know. But point is that if something goes up a lot before assays comes out, that's another that's like a optional profit in a sense. Whereas, like, I mean, take, or inflection might be the best one. There's always possibility that one can sell on drill hype, right? And I think we've seen, I mean, people, well, not even sell on drill hype, but it's like, it runs up and people take profits after it's been at the lows, for example. But at the same time, there's a long-term case, because in my view, it's like, and that goes for Rakla as well. If Rakla is indeed about to make a significant discovery that will prove to rival Snowline Gold, I would expect that to be trading at $1+ billion one day. So you can let that play out, right? An inflection, it's so cheap that there's a case where that the main case is not drill hype. The main case that it's such a good target, for example, and the price is not too high, that it makes sense that if you just forgot about those stories for 3 years or something, or 5 years, you're going to come back to either minus 50% or more than that or they actually did get significant, make a significant discovery, and you're up, I don't know, 500 to 1,000%. So there's an inherent case which includes taking as a risk. Then the optionality becomes, okay, if it gets really hot or something, that you can take profit if need be, because you got a reward without taking the assay risk yet. But with that said, if your case is based only on, let's say, drill hype, and you have no intention of you don't think the case is good enough to see assay risk, well, what happens if there is no drill hype? Then you open up, either you take, let's say, a loss or neutral, or you hold into assays where you risk of it going down. Okay, maybe this became quite convoluted, but my point is that the risk and reward is supposed to match, because maiden assay results, that is the highest risk part of the entire exploration story, because maiden discoveries can kill projects, or maiden assays can kill projects, regardless if the project is killed or not. I mean, if it's bad sentiment, they won't get any more money, and it's in a sense killed. And at the same time, it's not actually the highest reward. It might be the highest daily reward, because if Rattler, for example, or if Altamira comes out with like 400 meters of 1 grams per ton, that's probably gonna go up, especially if the market caps at these levels. If Rattler comes out with like 300 meters or 3 grams per ton, that's gonna go up, I think, in one day, quite a bit. But the actual big reward is not from one day moves, it's from the moves over 600 days, for example. But the risk is the highest at the initial, the maiden assays. And that's why if you do a longer term high risk high reward portfolio where you take that much big risk, you have to strap yourself to the chair, make sure you get the high reward. Otherwise it doesn't add up. You cannot be taking high risk. If you foresee it to be high risk news releases and you're okay with low reward, it just, I mean, that's why most of the time it's worth waiting for a discovery hole, because the price has not gone up enough to make the risk reward worse than holding it into the assay. So it's like any of these, like, examples, like I have, as you know, I have positions in Rattler, Finex, Westward Gold, Inflection, Red Canyon, Tectonic, or depending on, and none of those are like huge positions, but depending on what the results are in their, let's say, coming news releases, I might add. I'm probably more close to adding in any one of them than selling. It depends on the case. But why does it depend? Because it depends on the results. If Rattler delivers the best holes, I mean rivaling Snowline, and it goes up 100% to 200 million or whatever it is, depending what the results are from all those holes, that might look super cheap. But it might also look expensive, obviously. And the same goes for, like, anyway. I mean, if Altamira hits like 400 meters of 1 gram per ton and it's up 50%, maybe I'll be adding. It depends on the results. I don't have any strict rules. Because all of a sudden, let's say, the grad target, let's say it delivers, like, well, this looks like a Snowline deposit and it goes up 200%. Well, maybe all of a sudden I think there's a 50% chance this is going to be $1 billion in 1-2 years. Well, that's a 5x in 1-2 years, and I think there's 50% probability. Maybe I should have 3% of my position, and it went up to 2%, so maybe I should add 50%. I don't know how I'm gonna act. That's why I say it's like when people ask me about target prices, I don't know because I don't know what the results are gonna be. That's why it's fluid to me. Maybe some junior puts out some holes and it goes up 100%, but I don't think they're that good. Or maybe the market cap was already high enough that okay, now it's like pricing in a 60% chance that it's gonna be, I don't know, worth a billion, and I don't think it's a 60% chance. Yeah. Anyway, long rants. I hope you get something out of it. As always, consider biased. Don't see this as investing advice. I might buy or sell at any point in time. So you have to make up your own mind. I can't guarantee that I'll make money on any one of these juniors I hold. And again, it's like, especially it's like if I'm excited about especially a high risk high reward story. I mean, to me nowadays, a big position in a high risk high reward story might be 2% of my portfolio. Whereas like the old me would maybe have 20%. But then going back to how that's not really feasible most of the time, because there's no way I'm gonna probably have the mental fortitude to capture the high reward side of it. Anyway, yeah, thanks for listening. Bye, guys.